Wouldn't it be great if you could earn additional passive cash flow every single month? And there is no form of income more passive than the income from dividend stocks. Unfortunately, most of these stocks only pay a dividend once per year or sometimes once per quarter. But there are some stocks out there that pay dividends every single month. Today, we look at 6 of these stocks. But first, we need to establish some ground rules, as unfortunately, monthly dividend payments are far from a quality sign. Look at Armor Residential, for example. They are paying a monthly dividend, but investors in the company still lost money with the stock regardless of being invested 1 year, 5 years, or even 10 years. The total return always was negative. And not only that, even the dividend payments have decreased over time. So I think it's fair to say that an investment in ARR has not paid off, and unfortunately, that is true for the majority of the monthly dividend payers that I found. But as usual, here on this channel, I like to focus more on quality stocks, and for this video, I choose 6 stocks from more than 50 monthly dividend payers that I could find. My name is Florian, welcome to Cashflow Maniac. Before we have a look at the first stock that has a dividend yield of 6.6% by the way, let me explain the 2 simple selection criteria that I use. First, for this list I only used stocks with a market cap of above 500 million US dollars. Smaller stocks tend to have a higher volatility and are usually more prone to economic downturns. In case of monthly passive income, that risk is usually quite the opposite of what investors want. For this, I would rather focus on stable and safe payouts, and that brings me to my second criteria. I only included stocks in this list that have not cut the dividend in the last 10 years. Many of the stocks I found in this category have decreased the dividend payments several times over the last years. The feeling I got from my research is that dividend cuts are much more common in this category than usual. In many cases, the monthly dividend seems more like a way to lure investors into an investment that might otherwise be not that interesting for them. So, with these criteria in mind, let's have a look at the first stock, which is LTC Properties, and please keep in mind that today's video is only meant to introduce you to new stocks or new ideas, not to replace a more detailed analysis of each of these stocks. LTC Properties is a REIT that invests in a diverse portfolio of senior houses and assisted healthcare properties in the US through sale leasebacks, mortgage financing, joint ventures, or various other types of financing. They have the ticker symbol LTC and are listed on the New York Stock Exchange. The market cap is 1.5 billion US dollars at the moment. The market they are operating in is a growing market because the population in the US is expecting to get older and older, with the higher age brackets continuing to increase significantly over the next decades. So there is definitely an increased need for these type of properties, which gives LTC plenty of opportunities. As already mentioned, they are currently paying a dividend of around 6.6% with a 5-year growth rate of 3.7%. Their AFFO payout ratio, which is the payout ratio that REITs are usually measured in, sits at around 84%. Over the years, LTC could actually increase the dividend several times, and in the last years, even though they didn't increase it anymore, they could at least keep it stable. The company had quite a lower total return against the S&P 500 over the last year, the last 5 years, and even the last 10 years. So there was not much of any stock price appreciation, we only saw the dividend payments basically. One warning sign that the company shows is that the AFFO growth over the last years has been negative. And this is true for the last 3 years as well as over the last 5 years. One other risk that I found for the company is related to the operators that in case of trouble might not be able to pay their rent or obligations anymore, which already happened last year where the company had to write off all obligations from one operator. The second company, Gladstone Investment, is also the smallest of the bunch. Their ticker symbol is GAIN and they are listed on the Nasdaq. With a market cap of a bit over $500 million, they are the only company on my list with a market cap of under 1 billion, and they could just fulfill my first criteria. GAIN is a business development manager, or BDM in short, specializing on acquiring mature, lower and middle market companies, usually in the manufacturing or consumer product or services sectors in the United States. With their focus on investments in high quality businesses with a leading market position and positive cash flow instead of unprofitable startups, Gladstone investment strategy is more conservative than that of many other BDMs. In addition to this, they are also trying to keep their leverage quite low. They are paying a dividend of almost 7% at the moment, and with a payout ratio of 38%, the dividend seems secure at the moment. They could also increase their dividends over the last years with a 5-year CAGR of 9.5%, but this also includes the payment of special dividends that the company pays in addition to their regular monthly ones. I do like this kind of approach, as these special dividends are only paid when the company has excess cash. So this gives Gladstone more flexibility, but also makes the total amount of dividend paid a bit less secure. It also helps to keep the regular dividends safe though. The total return of the last year and the last 5 years was basically on par with the S&P 500. But over the last 10 years, they could outperform the S&P 500 by quite a bit. Jamie Dimon, the CEO of JP Morgan, actually issued a warning for the whole private credit sector. But I'll go over this in more detail in a bit when I discuss the next BDM company. But first, coming from the smallest to the biggest player on my list, and a player that is probably no surprise to you. I mean, they call themselves the monthly dividend company. Of course, I am talking about Reality Income. They are listed on the New York Stock Exchange with the ticker symbol O and have a market cap of 46 billion US dollars at the moment. O is the second REIT and probably the most well-known company on this list. So let's go over Reality Income quickly before we come to the next company, which might be new for you again. Reality Income is a globally diversified REIT that focuses mostly on retail and industrial clients with long lease terms. They are a member of the elusive list of dividend aristocrats and could increase their dividends over 30 years straight. They have a dividend yield of almost 6% and a 5-year growth rate of 3.5%. Their AFFO payout ratio sits at 75%, which is very reasonable for a REIT, so no worries here. Unfortunately, Reality Income did underperform the S&P 500 over the last year, the last 5 years, as well as over the last 10 years. But we also see that this underperformance mostly came from the last couple of years, where we saw increased interest rates, which put some pressure on all kinds of REITs. If you do like the video so far, please smash the like button and consider subscribing to the channel in order not to miss my next video. The next company on the list is also a REIT, but this time with a focus on industrial properties. Stag Industrial. They have the ticker symbol of STAG and are also listed on the New York Stock Exchange. They are owning 570 buildings all over the US, with 1/3 of their portfolio being located within a 1-hour drive to megasite projects that are listed on the Investing in America initiative that already saw significant private and public investments. By targeting these areas and types of properties, the company has developed a strategy that combines income with growth. Stag is currently paying a dividend of 4.2% with a small 5-year growth rate of around 0.7%. As a REIT, we are looking at the AFFO payout ratio again, which sits at around 70%. Again, this is a very nice value for a REIT and even a bit below the industry average. So the dividend is well secured. And while the dividend growth is not huge, in all of their history, the company never had to lower it either. The performance of the company was basically on par with the S&P 500 for most of the last 10 years, and only the AI-fueled run-up since 2022 did push the S&P 500 ahead. So in the last year, the S&P 500 also did outperform Stag by quite a bit. Next on the list, we have Main Street Capital, a business development company also listed on the New York Stock Exchange with the ticker symbol of MAIN. With a huge 7.4 billion in capital under management and a market cap of 4.6 billion, they are quite a bit larger than the last BDM on this list. They are targeting lower middle market companies with a revenue between 10 million and 150 million and an EBITDA between 3 and 20 million in all over the US. They are investing in a very diversified portfolio over many segments, and on average, they are owning positions of around 40% in their invested companies. Main is paying a dividend of 5.8% with a dividend growth rate of almost 4% over the last 5 years. Their payout ratio sits at 67%. The company also had to never lower the dividends and is even paying additional special dividends on occasion. Their past performance is one of the best ones on the list, and in the last years, as well as over the last 10 years, they could outperform the S&P 500 from a total return perspective. I mentioned before that Jamie Dimon issued a warning for this whole private credit market. He especially warns that many of these companies are not stress tested yet, and most of them are still quite young. He also warns that there are many players, and I quote, "Not all the people doing it are good." He goes on saying that he saw some of these deals and it shocked him how they got rated. This situation right now reminds him a little bit of mortgages, referring to the real estate bubble. So please, be extra careful when investing in such BDM companies. As reference, I'll put the link to the interview in the description below so you can listen to the whole thing by yourself. And while you're down there by the comment section already, I would love to hear what you think about this and if it might be interesting for you if I dig a bit deeper into this topic. When there is enough interest on this topic, I'll definitely consider doing a deep dive video on this. The last company on my list, and one that I find quite interesting, is Agree Realty Corp. This is a net lease REIT listed on the New York Stock Exchange with the ticker symbol of ADC. Agree Realty is developing high-quality retail properties with big and well-known customers like CVS, Costco or McDonald's, with their biggest customer being Walmart. Almost 70% of their customers have very strong balance sheet with investment grade ratings and only 15% are sub-investment grade. The rest is unrated as of today, but with players such as Aldi and Boot Barn are also far from trash. ADC is currently paying a dividend of 4.9% and they could increase their dividend with a CAGR of 6% over the last 5 years. Their AFFO payout ratio sits at 73%, which is about the industry average and no reason for concern. The company had to lower the dividend once back in 2010, but since then they could steadily increase it on a regular basis, and since 2021 they are paying a monthly dividend. Over the last year, the company did unfortunately underperform the general market, and over the last 5 years, the total return was basically flat. But despite this current weakness, over the last 10 years, the performance is still almost on par with the general market. So here you have the full list of my 6 favorite monthly dividend payers. As full disclosure, I am not invested in any of the companies on this list. I also think that just paying a monthly dividend is not a good criteria to invest in any stock. But with Gladstone Investment and Agree Realty Corporation, there are 2 stocks on the list that I do find quite interesting. But of course, as I also mentioned in the beginning, today's video is by far not a conclusive analysis. It is purely meant to introduce you to companies that you might not have known before and give you an overview of the monthly dividend payers that might be worth a deeper look. So please, before investing, do your own research and only use this video as a starting point for your own analysis. And if you are looking for a dividend payer that is not paying a monthly dividend but is operating in a hugely growing market and shows every sign of a great compounder, you might want to check out this video.